Something happened in the housing market that should have been everywhere. Mortgage rates doubled, affordability collapsed, buying power fell off a cliff, and yet almost nobody sold. That's the part that doesn't make sense. If owning a home became dramatically more expensive, prices should have fallen fast. If buyers disappeared, inventory should have surged. If the market was broken, something should have cracked. None of that happened. Instead, prices stalled, listings dried up, owners stayed put, and suddenly owning a house started to feel less like security and more like a commitment you couldn't exit. This is where the story everyone tells you about housing stops being true. The old story says a home is always a good investment, that it's forced savings, that it anchors the middle class. That story worked when ownership meant flexibility. It doesn't anymore, because a house quietly stopped being a home first. It became a financial product. And once that happened, the rules changed. At first, nothing felt wrong. Rates fell. Monthly payments looked manageable. Lenders told you what you could afford, not what the house cost. What the payment costs, that shift sounds small. It isn't. When payments become the focus, prices lose their anchor. You saw this in real time. Rates dropped, but homes didn't get cheaper. They got bigger. They got nicer. They got more expensive. The payments stayed familiar. The debt exploded, and debt has gravity. Once you take it on, it changes how you move. This is the part that feels counterintuitive. Owning a home didn't trap people when prices were rising. It trapped them when rates rose, because suddenly selling meant giving up something irreplaceable, a cheap mortgage. People didn't stay because they loved their house. They stayed because leaving was financially irrational. That's not ownership. That's lock-in. You noticed it if you paid attention. Friends who wanted to move didn't. People who needed flexibility lost it. Job opportunities became harder to take. The house didn't make them wealthier. It made them immobile. This is why housing didn't crash. It froze. And frozen markets behave very differently from falling ones. Prices don't adjust through sales. They adjust through exclusion. New buyers get locked out. Existing owners stay put. Investors step in selectively, and the system stabilizes at a higher level of pain. Now, here's the question everyone asks instinctively. If rates doubled, why didn't prices collapse? That answer matters. But you can't see it yet, because before you understand why prices didn't fall, you have to understand who owns housing now, not emotionally. Structurally, home ownership used to mean households. That's no longer true in many markets. Large players quietly accumulated inventory over the last decade. Blackstone didn't buy homes because it believed in the American dream. It bought predictable cash flows. Invitation Homes didn't care about appreciation narratives. It cared about rent checks that adjusted with inflation. Public REITs didn't need prices to soar. They needed occupancy and duration. Once institutional ownership reached a certain level, housing stopped clearing like a normal market. Investors don't panic sell. They refinance. They wait. They turn ownership into yield. That creates a price floor. Not because homes are affordable, because selling isn't necessary. Now, layer in the second force most people ignore: local governments. Property taxes don't fall when prices stall. They rise when assessments catch up. Municipal budgets depend on them, so higher prices become politically sticky. Insurance added another layer. Premiums didn't rise evenly. They exploded in specific regions. Climate risk, rebuilding costs, legal exposure. Suddenly, ownership came with unpredictable expenses that renters never saw. This is where the trap tightens. The house looks like an asset on paper, but it behaves like a liability in practice. Maintenance doesn't care about appreciation. Insurance doesn't care about equity. Property taxes don't care about your income. They care that you stay. And staying became the default. This is why owning started to feel heavy. Not because prices were high, because exit got expensive. Now let's talk about behavior, because this is where outcomes diverge. Some people stretched for maximum approval. They bought the biggest house the lender allowed. They assumed appreciation would handle the risk. They assumed refinancing would always be available. When rates rose, options disappeared. Selling meant losing the cheap loan. Refinancing meant higher payments. Moving meant starting over. They weren't ruined. They were constrained. Others did something quieter. You didn't buy the maximum house. You bought below your limit. You treated the mortgage as a cost, not a trophy. You ran scenarios where rates didn't fall again. That decision didn't feel smart at the time. It felt conservative. When conditions changed, nothing dramatic happened to you. You didn't need to move, but you could. That difference is everything. This is the part most people miss. The housing trap isn't price. It's permanence. A house becomes dangerous when it removes optionality, and optionality is what turns ownership into power. Without it, ownership becomes obligation. Now let's widen the lens. Housing didn't change in isolation. It changed because the economy needed stability without mobility. Debt provided that. Long-term mortgages lock people in place. Locked in people don't disrupt systems. They don't take risks. They don't move freely. That's not a conspiracy. It's a byproduct. And systems always evolve towards stability. Now, here's a subtle shift that explains everything. Houses stopped being assets you could trade as they became positions you hold like a bond. You collect utility instead of yield, but you also absorb duration risk. If that bond can't be sold without penalty, you're holding it until maturity, whether you want to or not. This is why younger buyers feel different pressure. They're not buying into a ladder. They're buying into a position with unknown duration. They don't fear price drops as much as they fear being stuck. Now, here's the promise everyone wants fulfilled. If owning a house is becoming a trap, who is it trapping? And who is it protecting? That answer is coming. But before it lands, you have to understand why policymakers tolerate this, why prices remain sticky, and why waiting for a crash is the wrong strategy. Because housing doesn't reset the way stocks do. It resets through people's lives. In the next part, we're going to look at why prices don't fall, even when affordability collapses, who benefits from that friction, and how some people use housing without letting housing use them. Because the people who win next won't be the ones who avoided homes. They'll be the ones who avoided being trapped by them. Subscribe, like, and let's continue. Once you accept that housing didn't fall when affordability collapsed, the next question becomes unavoidable. If buyers disappeared, who replaced them? The answer isn't investors in the way people usually mean it. It's balance sheets. Housing didn't get rescued by demand. It got stabilized by structure. When rates rose, something counterintuitive happened. The people who already owned homes didn't rush to sell. They froze. Because selling meant exchanging a fixed, cheap payment for a variable, expensive future. That decision wasn't emotional. It was arithmetic. And arithmetic beats sentiment every time. This is why inventory dried up instead of exploding. People don't sell assets when the replacement cost is worse. They hold, and holding is easier when ownership is leveraged cheaply. That's the first force keeping prices sticky. The second force sits behind it quietly. Institutional ownership. Blackstone didn't need to buy every house. It needed to buy enough to change market behavior. Invitation homes didn't need appreciation. It needed rent checks that adjusted faster than wages. Once large players own a meaningful share of housing, the market stops behaving like a market. It behaves like a yield machine. Yield machines don't panic. They refinance, they securitize, they wait. This is why price discovery slows. Not because homes are worth more, because fewer sellers are forced to sell. Now, add the third force that almost no one talks about. Local governments, property taxes fund schools, infrastructure and services. Assessments lag prices, but they don't reverse it. Once budgets expand, they don't contract gracefully. So falling prices create fiscal stress. That creates political resistance. Nobody campaigns on lower property tax bases. So housing becomes supported indirectly, not by policy announcements, by inertia. Insurance adds another layer of friction. Premiums rose faster than mortgages in many regions. Climate risk, rebuild costs, legal exposure. These costs don't show up in listing prices. They show up monthly, which means ownership becomes unpredictable. Unpredictability changes behavior. People don't sell, they endure. This is how pressure accumulates without release. Now, here's where most people misunderstand what a trap actually is. They think a trap means loss. It doesn't. A trap means constraint. You didn't lose money on paper. You lost freedom of movement. You couldn't relocate easily. You couldn't downsize without penalty. You couldn't change careers without risk. The house anchored you. And anchors are useful in storms, but terrible when you need to move. This is why the same house feels safe to one person and suffocating to another. It depends on flexibility. Now let's talk about who benefits from this structure. Not in theory, in cash flow. Mortgage servicers benefit from duration. They don't care if prices rise or fall. They care that payments continue. Insurance companies benefit from complexity. Rising premiums increase revenue faster than claims until they don't. REITs benefit from rent inflation and supply scarcity. They don't need turnover. They need occupancy. Utilities and infrastructure benefit because housing permanence locks demand geographically. You don't shop for a new power grid when you're stuck in one place. This is why asset-heavy, location-bound businesses gain stability when housing freezes. Now contrast that with who absorbs the cost. New buyers face higher barriers. Recent buyers face higher risk. Mobile workers face fewer options. The system rewards those already inside and penalizes those trying to enter, not through exclusion laws, through math. Now, let's talk about behavior again, because this is where outcomes diverge. Some owners treated appreciation as income. They borrowed against equity. They upgraded lifestyles. They assumed refinancing would always be available. When rates rose, that strategy collapsed, not catastrophically. Gradually, payments rose. Options narrowed. Stress increased. Others treated equity as insulation. You didn't tap it casually. You didn't assume it would save you. You treated the house as shelter first. That decision felt boring. It preserved margin. When costs rose, you adjusted. Nothing dramatic happened. This is the difference between using housing and being used by it. Now, here's a subtle shift that explains why waiting for a crash doesn't work. Housing doesn't clear through prices like stocks. It clears through time. People delay selling. They rent instead. They cohabitate. They commute farther. The pressure spreads out, which means pain increases without release. That's why affordability can collapse without a price collapse. The system redistributes stress, not value. Now let's bring companies back into the picture. Because markets price this reality, home builders behave differently now. They don't rush to increase supply. They manage margins. Limited supply supports prices. Mortgage lenders focus on servicing rather than origination growth. REITs focused on rent growth rather than turnover. Public companies adapt to permanence. This is also why certain cities diverge sharply. Places with insurance risk and tax pressures see hidden costs explode. Places with constrained supply see prices hold despite weak demand. There is no national housing market. There are dozens of microsystems responding to the same forces differently. Now let's return to the question we've been circling. If owning a house is becoming a trap, who is it trapping and who is it protecting? The answer isn't owners versus renters. It's flexible versus fixed. Housing protects those whose lives are already stable. It traps those whose lives need to change. That's the inversion most people don't expect. In the past, ownership created stability. Now, it requires stability up front. That's the catch. Once you see that behavior shifts, you stop asking whether prices will fall. You start asking whether you can move. You stop focusing on appreciation. You focus on optionality. You stop optimizing for leverage. You optimize for exits. This is why some people chose smaller homes or shorter mortgages or regions with lower fixed costs. Not because they hated ownership, because they understood duration risk. They didn't need the biggest asset. They needed the least restrictive one. Now, here's the final promise that needs to be earned. If the housing market is structurally sticky and ownership increasingly constraining, what does winning actually look like? That answer isn't don't buy. It's more nuanced. And to get there, you have to understand how housing fits into the broader system of debt, labor, and mobility. Because the real trap isn't owning a house. It's owning a house that owns your future. In the final part, we're going to bring this to its conclusion. We'll look at who should own, who shouldn't, and under what conditions housing still works. We'll look at why some owners quietly do fine while others feel squeezed for decades. And we'll end with the only question that actually matters in this market. Not how much a house is worth, but how easily you can leave it. By now, the pattern should feel uncomfortable but familiar. Housing didn't fail. It hardened. It stopped adjusting through price and started adjusting through people. And once you see that, the final question stops being theoretical. Who should actually own a house in this system? That answer isn't simple, and it isn't universal, because the housing market no longer rewards ownership equally. It rewards stability. If your life is already fixed, housing works. If your life needs to change, housing resists you. That's the inversion. The same asset that protects one person traps another. This is why two people can buy identical houses and have completely different outcomes. One feels secure, the other feels stuck. The difference isn't the house, it's optional. Now let's talk about the people who quietly avoided the trap without rejecting ownership. They didn't time the market. They didn't wait for crashes. They didn't listen to narratives. They asked better questions. Instead of asking how much house they could afford, they asked how easily they could leave. Instead of asking how much appreciation they might get, they asked how much fixed cost they were locking in. Instead of asking whether owning was better than renting, they asked whether owning reduced or increased future pressure. Those questions led to very different choices. You didn't stretch for the maximum mortgage. You bought below your means. You didn't assume refinancing would always be there. You assumed it wouldn't. You didn't treat equity as spending power. You treated it as insulation. That meant you gave up some upside. It bought you something else. When rates rose, nothing broke. When costs increased, you adjusted. When opportunities appeared elsewhere, you could move. That's not luck, that's structure. Others optimized for a different world. They assumed low rates were permanent. They assumed appreciation would offset everything. They assumed mobility wouldn't matter. When conditions changed, the house didn't collapse their finances. It compressed their choices. They couldn't sell without penalty. They couldn't rent without loss. They couldn't move without resetting everything. The house didn't ruin them. It narrowed their life. Now let's widen the lens again, because housing doesn't exist in isolation. It sits inside a larger system of debt, labor, and mobility. Long-term mortgages do something subtle. They reduce labor flexibility. People with large fixed obligations don't take risks easily. They don't change careers easily. They don't relocate easily. They don't absorb shocks easily. That's not a moral judgment. It's math, which is why housing became such a powerful stabilizer for the system. Stable people don't disrupt systems, and systems reward stability. This is why policymakers tolerate housing stress without forcing resets. Price declines create instability. Stagnation spreads pain quietly. Quiet pain is easier to manage. Now, let's talk about companies again, because markets already reflect this reality. Institutional landlords don't care if prices double. They care that rents rise steadily. That's why firms like Invitation Homes and American Homes for Rent focus on occupancy and duration. REITs don't need mobility. They benefit from immobility. Utilities benefit when populations are locked geographically. Insurance companies benefit when coverage becomes mandatory and expensive. Mortgage servicers benefit when loans persist. None of these actors need a housing boom. They need housing permanence. Now, look at home builders. They don't flood the market when demand rises. They manage supply. Limited supply supports prices. Prices support margins. That's why builders don't rush to solve affordability. Affordability is a social problem. Margins are a business problem. Businesses solve the second one. This is why waiting for a housing crash misses the point. The system doesn't need a crash. It needs endurance. Now, let's come back to the promise that's been hanging the entire time. If owning a house can be a trap, how do you tell whether it will trap you? The answer isn't in the price. It's in duration. How long do you need to stay? How predictable are your costs? How easy is it to exit? If you need flexibility and housing removes it, that's the trap. If your life is already stable and housing reduces uncertainty, it's protection. That's why blanket advice fails. Ownership isn't good or bad. It's conditional. And the condition is stability. This is also why younger generations feel conflicted. They don't hate ownership. They fear permanence without certainty. They sense that locking into a long-term position before life settles is risky. And they're not wrong. Now, here's where everything comes together. The housing market didn't break. It completed its transformation from a ladder to a lock, from a path upward to a position you hold, from something you traded to something you endure. Once you see that, the winning move becomes clear. Not avoiding housing, avoiding being trapped by it. You don't need the biggest asset. You need the most flexible one. You don't need maximal leverage. You need controlled duration. You don't need appreciation fantasies. You need predictable outcomes. That's why some people choose smaller homes or shorter mortgages, or regions with lower fixed costs, or even renting when it preserves mobility. Not because renting is superior, because optionality is. This is also why housing no longer defines success the way it once did. Success used to mean owning early. Now it means owning appropriately. That's the shift most people haven't articulated yet, but they feel it, and feelings always precede understanding. Let's end with the truth that sits underneath all of this. A house only becomes a trap when it decides your future for you, when it dictates where you can go, what risks you can take, how you respond to change. The people who struggle most aren't the ones who didn't buy. They're the ones who bought without margin. The people who do fine aren't the ones who timed the market. They're the ones who preserved choice. That's the real divide forming now. Not owners versus renters, but flexible versus fixed. And in a world that's changing faster than housing can adjust, flexibility is the asset that outperforms everything else. Quietly, consistently, without needing a crash. That's why owning a house is becoming a trap for some and a shield for others. The difference isn't the market, it's how much control you keep after you buy. And once you understand that the decision stops being emotional, it becomes structural, which is the only way to make it work in the world that exists now, not the one people still talk about.